So what I thought I'd do today, instead of presenting slides, was to rather talk to you. I'll share with you where we are indeed finding value in this market. So I'll take you through a very brief backdrop in terms of the macros, what we're looking for in terms of the economy, and then I'll go through into the asset classes of choice, just given where we are seeing opportunities. And then I'll dive straight into some of the stocks, some of the themes that we are finding opportunities also, but also maybe one or two that we think are best left on their own in terms of avoiding them. And then I'll share with you a contender or one idea that we have that, should things play out over the next while, could actually surprise on the up. So starting off with the macros, we are in this camp of South African GDP being on the recovery. So we are on the mend, just given the deep drawdown that we saw last year as a result of the COVID pandemic. We're looking for about 5% GDP for this year, with another 2.5% or so for next year, which takes us basically to where we were at the beginning of 2020. So not a great outlook from a macro point of view, but nevertheless very constructive, very sort of conducive in terms of some of the ideas that we have from an earnings growth in particular. For us to can grow and show good traction for the South African economy, we think that we need, there's so much talked about reforms to actually come through for us to actually have a sustained growth path that can absorb the high unemployment levels and actually create a slightly different growth path and also earnings and outlook for the companies that we look at. So just given that brief outlook from a macro point of view, where are we finding value? So one of the areas in terms of my responsibility is to look at sort of multi-assets, not just the equities in particular. So across the board, across the different multi-assets that we look at, equities is the asset class of choice, right? Both domestically and globally. On the domestic side, we look at our equities, we think they're cheap relative to own history, relative to peers. Whether you look at it from a price-to-book point of view, whether you look at it from a forward PE point of view, we think our market offers a lot of value from this point going forward. Also, compared to the other asset classes, if you look at cash, not going to do much over the next while, largely because, again, as part of our macro view, we do not believe that we are about to see a massive resurgence in terms of the interest rate trajectory that we've seen over the last while. We think that rates are going to be lower for longer, largely because we're not seeing massive pricing powers in the economy to can actually warrant an MPC move to can take rates to perhaps where they were pre the pandemic. So as a result, we do not like cash at all. On the bond side, yes, there is some value, but compared to equities, we think equities actually can do up another 20%, over the next 18 to 24 months from this point onwards. So where does that 20% come from, right? So there are three big components in terms of total returns that we look at from an equities point of view. One is dividends, and I'll chat to that a little bit later. The other one is earnings, and then the third one is ratings. So on the rating side, this is one area where we're not that bullish, we're not that positive, largely because for the market to actually re-rate to perhaps a long-run historic levels, we need these reforms to actually come through. So we think the market on a ratings point of view will remain perhaps at a discount, but we think there's enough levers, both in terms of dividends and earnings, that can actually take us through in terms of that total return expectation of 20%. So before going into some of their stocks, some of the ideas that we have, from an Allan equity point of view, what are the three things that we look for in terms of stock picking? One, it has to be cheap, so we look at valuation. Secondly, from a quality point of view, this is where we bring the ESG side of things. It has to be a good quality score, having gone through our quality ESG framework. And then thirdly, there has to be a few levers, a few thematics that are in play to can actually enhance the investment case that we're seeing, both from a valuation point of view. So given that three-pronged framework, where indeed are we seeing value, right? So as a start, we like commodities. We think the commodity segment SA has got a lot more legs to run. Yes, the prices have come off off their peak over the last few while, but we think, from a sustainability point of view, there is still enough traction still to be had that should propel our commodity stocks into better valuation and returns going forward. We think the whole decarbonization process that we're seeing away from fossil fuel into clean energy still plays into the hands of some of our commodity stocks. So if you look at platinum, you look at other commodities, especially palladium, uranium, we think those should still benefit. If you're looking at renewables, a lot of the equipment needed in that space actually still comes from some of the commodity producers that we have. So in that space, we like Billiton, we like Anglos, and we actually are very humbled by the behavior of the management teams in this cycle, where we have seen a lot of capital being returned back to shareholders, which is another underpin in terms of returns that we're looking for from a dividend point of view. So we think that dividend return a theme continues, even as and when the prices have come off, largely because these businesses, they are highly cash generative, right? So the prices have come off, but they operate at a lower cost point in a cost curve, such that there's still a lot of buffer before they actually go into loss-making a situation. So for us, that's one area where we are finding a lot of opportunity still, despite the recent sell-off that we've experienced. In fact, we kind of look at that as an entry point or a buying opportunity, given our long-term view on the commodity cycle. So that's the first group of opportunities that we're seeing on the commodity side. We prefer, as I said, diversified miners, billetin and Anglos. We're shying away a little bit from the single commodity producers, the iron ore and the coal, but we still like platinum. So the Impalas and the Amplas of this world, we are still exposed from a portfolio positioning point of view. So the second group of stocks is what I would call the self-help type stories, or these are companies or businesses that somehow, despite the macro situation, despite the doom and gloom, despite the negative sentiment that we're seeing, they somehow manage to surprise on the up. They have enough levers within their armor to can actually pull and still deliver for shareholders. So there we like the likes of Motors. So Motors was spun out of Imperial about 2 years ago. Great little business. Yes, the share price has done very well over the last while, but we think there is more to come. So what Motors does is they play in the second-hand car market in terms of retail. They also play in the entry level in terms of new cars. But what is of interest for us is the actual value chain that they play in within the automotive industry. So the financing, the insurance, the servicing, that entire value chain, we think they are well placed to can actually benefit. And we are seeing the results come through on a consistent basis since spinning out of Imperial. Another one is Mr. Price, in the apparel space. Again, I'm a sort of a low entry in terms of price points for the consumer, but the quality is actually top-notch. So the consumer is not only being shortchanged by paying a sort of a lower price, but is getting the right quality from a product point of view. The management team there has been there for a while. I mean, they know their markets, they know their business, they know their clientele, and again, somehow they just managed, to deliver a little bit extra, despite what we may see from a macro point of view. They managed to steal market share from their peers. They play, sort of across the different segments from a consumer point of view, and for us, this is one area that we think we are nicely exposed. And it's not the most expensive retailer in the market, especially if you compare to some of the other peers, your Foshinis, in terms of the price point and the valuation. And then ShopriteRite, you have to have some food in your portfolio. For us, that is the stock of choice. Again, I mean, these guys, they just managed to carry on from the previous management team to the current one in terms of just doing the right things at the right time. Stealing market share, expanding margins, managing the business very, very well, very tight cost management, margins opening up. And then for us, that's a good bellwether stock to actually have as a cornerstone in a portfolio. I guess just like all the other speakers, we are positive on the banks, but for us, it's more around FirstRand and Nedbank. So if you look at those two specifically, the FirstRand, better quality, but for us, the most interesting thing with FirstRand is that retail business, that F&B business. That is the machine, right? Just continues to pump good earnings, good ROEs, is highly well managed, continues to actually add customers, and is growing not on the back of credit, which is a bit dangerous because you can get caught up with impairments, but they have all these other value-added services that they offer their customers that require very little capital. So from a capital deployment point of view, the returns are actually exceptional, which then also bodes well for the entire FirstRand group. Nedbank, we think they are best placed to can play in this whole renewable energy space. They are the green bank, I guess, for a reason. They have been there for a while. They are the pioneers in that space, and we think they are best placed to actually benefit from the latest announcement in terms of the upping of the cap. And then the other one, I suppose, to some extent, similar to Motors, similar to ShopRite, is Bidvest. So we like Bidvest. It's got its tentacles across the entire SA sort of a macro economy, and it gives a nice feel as to what's happening out there. And if you look at the results that have come out a few days ago, it seems like it's a steady shape that is well on track. Then the third bucket, it's a group of stocks that for some reason kind of find themselves, at the crosswinds of regulation, right? So here specifically, I'm talking about Process, I'm talking about Naspers, and you can throw in there, MTN, you can throw in there MultiChoice. These are stocks that they have an addressable market, right? So they are real businesses. They are making good money. There is demand for their services, and they're actually growing, into those markets. But for some reason or the other, they just find themselves at the crosshairs of the regulators, for good or bad reasons. So I'm not about to make a prediction on the regulation in terms of where it's going to go. And I saw this morning in China, it seems like there's a lot more still, in terms of uncertainty coming through there, which obviously impacts some of the stocks. But if you are able to just park, the noise and the uncertainty that comes with the regulation and actually look at these companies and look at the stocks, indeed, for us, we are seeing a lot of value. They have underperformed quite a lot, especially Naspers and Process of late, but we are finding a lot of value in those companies. They're not going to disappear overnight, despite the regulatory issues. In fact, on the regulation itself, if I may very briefly, we are very sympathetic to some of the issues that are being raised, right? So the whole social inequality is a big issue. It's not sustainable that you have very few people making a lot of money that are leaving a lot of people behind in terms of wealth creation. So yes, there is a need to address some of those issues, but I guess the issue from an investor point of view is we're not seeing a clear line of certainty in terms of where this is likely to end, this regulatory issue. So the markets like certainty, and to the extent that we're not seeing a lot of certainty, we're creating this volatility, and hence, what we're seeing currently in terms of our share price and reaction. But we are comfortable that in the fullness of time, certainty will come. It has to. From a Chinese authority point of view, we think that despite sort of their good intentions, implementation is a bit of an issue. But we think that in time, hopefully, that does settle down. The markets get a sense, will get a sense of certainty as to what will go on. It may just happen that at that point, you do have perhaps margins coming off, because of regulation. Some of the business may end up being split up, because again, you're trying to prevent anti-competitive behavior. But nevertheless, if you look at the fundamentals of those businesses, what they do, how they earn money, I would think that story for us remains intact. Then the areas where we are shying away is South African property. So we're not bought into that sector at all. So despite the 25% recovery we saw last year and another 12% plus that we've seen this year, we think the fundamentals, through the cycle are very, very challenged. So if you look at office for us, we don't like that space at all. And it's not just the work from home phenomenon. You just need to look at the top line, which is revenue, right? The guys are not getting the rental revisions that they need to get. You look at costs. Costs are running way above, the top line, which is not a great business model, which means, therefore, that distributions are going to be challenged going forward, and that will have an impact on the quality of the balance sheet. If you look at retail, it's a little bit better, but there are pockets where still we'd like to be away. So the super regional malls, we think there's a lot of over trading in that space. We like, your neighborhood malls a little bit better. And then where we are a little bit sanguine and not really sort of strong either way is on the industrial side. So it's there had been some value. We like the story, but we think that value has since sort of been captured. It has since been delivered on. And then lastly, but definitely not least, so looking forward, if I were to come back this time next year, and then you ask me, what was my top pick and how has that played out? I'd like to put forward a stock in the hospitality sector. So if you look at that sector, it has completely been decimated. The lockdowns, the travel bans, not enough inward bound tourism, that sector actually needs to can actually grow. But then there's a little sliver of sort of a good line. Excuse me. There's some hope, in that space. So if you look at a stock like City Lodge, completely decimated in terms of share price appreciation over the last while. But as and when the economy opens up, hopefully we roll out on the vaccinations, the business traveler has to get back and actually start a meeting. If you think about it very simplistically, it's easy for you and I, if you have a relationship, to actually maintain that on Teams or virtually, but to actually knock on new doors and introduce new relationships, from a business point of view, you have to meet people. You can't do M&A over Teams. So for us, we think that is a strong contender. Yes, there are some risks attached to that, but we think hopefully this time next year, we'll look back and hopefully that would be one of the ones to have had in the portfolio. So thank you for your time. Thank you for having me. I look forward to your questions a bit later.